The government is not going to make everybody whole. We're going to common sense, speculation, bonuses, high salaries, and the new rich of the world. And it's not the taxpayer, it's everybody, even if you didn't pay taxes and just had a deposit in the bank. And it's coming, it isn't coming isolating in the United States. Our banking system is no better than the banking system in Europe, truth to be told, because of the ability not to have to value that crap paper over-the-counter derivatives held by the banks, because our gatekeepers of accounting have blessed banks to put whatever value they want on that paper. There's the black hole. The black hole that is unaccounted for is the loss the banks are carrying on legacy paper. And those losses are to zero. The definition of infinity is 0.70 on the USDX. It would be significant weakness of the U.S. dollar back to its old low and then below that would cause QE change. Now, let's go back to how they thought this was going to happen. So if we want to give Bernanke a break, let's say that he had been successful with QE and we were in a significant, sustained, long-term economic recovery without any doubt. Then you would think that the balance sheet repair could take place of the banks, institutions, and businesses, because it's all balance sheet when you get down. If there's any reason why Bernanke is happy in his retirement, it's recognition of that part of the formula not having been fulfilled, and therefore QE not productive in terms of how it was originally set out. Now, what is the limit to QE? QE is limited by the condition of the U.S. dollar. What is the U.S. dollar tied to? Confidence. What is confident? What would happen if there was a loss of confidence? A higher price for gold. Clearly, we're not going to bring down the debt level. The economy is not in a bold, sustainable recovery. Europe is not in a bold, sustainable recovery. The loss that's not accounted for is the difference between the real value of the over-the-counter derivatives held by the world banking system, especially the Western banking system, because remember in China they executed people for dealing in derivatives. They have a little different attitude towards it. And that loss is what Bernanke had hoped the banks would earn back and be able to recognize slowly. But they haven't either recognized it slowly or earned it back. And now we've gone into a situation where the conduct of our banking community is clearly through the fines that are being paid and agreed to quite readily and easily. I think I could probably call up one of the major banks today and suggest to them that TRX was going to fine them $2 billion for some sort of impropriety, and they'd start negotiating. We are in a situation which is as bad or worse than 2008. And we've got so many fingers and so many dikes that it would only be a miracle if it held together. A recognition of anything that affects confidence takes every finger out of the dike and brings in a situation as a multiple of the problems we went through in 2008. We would probably attack them as a terrorist nation. That's something that's even impossible to think, because the main strength of the U.S. dollar is petrodollars. The main source of petrodollars, dollars exchanged for oil, is Saudi Arabia. Should there be a change in that, the dollar would drop 300 points in one single day. I believe the dollar will go to 56 on the USDX index.
So the dollar would, let me get this straight.
Terrible fall. The dollar would take the first major crack technically in the dollar, breaking an enormous. I mean, if you looked at the long-term chart of the dollar, you'd have a heart attack. The thing is loaded with head and shoulders all over the place. Not only is the whole thing a head and shoulders going back many years, but there are little ones everywhere. And it would take the major head and shoulders out, which is from 125. Well, if you took out the major head and shoulders from 125, which would be taken out in a fall to 70, can you imagine where it would go? Because of the impact on the dollar And it would also take the euro to very high levels. You know, we've talked to the euro positively when it was $1.19. And we were the only one out there saying that the euro was going to lead the dollar coming into 2014. Well, there's no arguable fundamental reason why it should, but it will. Yes, that's what I'm saying. But if we apply that to mortgages, we better go back and look at what's happened in history. Take the peso, for instance, as being a recent revaluation in 1994. What happened to mortgages there? They were reset against the new peso. So let's be a little careful about saying that one Kruger Rand will pay off a $50,000 mortgage. In all probability, by historical precedent, won't, because the bankers of today won't be screwed. There's not going to be a free pass. They're going to revalue in the new currency. Another reason why you must own gold, or in currencies, you have to own the strongest currency. And you're up against the smartest minds in the world, and it's an inside game, and unless you're on the inside, you can't play the game. And no margin, no borrowing on anything gold, gold shares, GLD for that matter, no margin whatsoever. Based on the emancipation of physical metal from paper gold. And the tool of emancipation is the warehouses of the futures exchanges. For if the warehouses of the future exchanges can't be counted on to make normal deliveries, then the exchanges will have to make a change in the contract in order to avoid default, and they'll make that change to avoid default. That's what they panicked about back in the Hunt days, which I know an awful lot about. They bought their own rumor. Bunker and Herbert were two different guys, and Bunker didn't do paperwork as good as Herbert did. So they missed the first notice day by 3 days, and the crazy guys on the COMEX decided they were going to take delivery, and that was evidence that they were going to take delivery. Well, the only evidence it was that Bunker was a little sloppy with his paperwork. And as you know, I was very much involved in liquidating. Also the reason why I've just accepted a position as chairman of the advisory committee for the establishment of the Singapore Gold Exchange. And this gold exchange is going to trade physical gold, not future gold. And we're basically trading a spot contract only, because the emancipation of physical gold from paper gold will allow a true valuation to be. You can't come in. The way manipulation is done, and Greg, I've done it. It doesn't make me any better because I manipulated it up than the person who manipulated it down in another incarnation when I was 35 years old. But all you do is you come in and let's say you wanted it up, you bid for a year's production. Nobody's got it. Nobody's going to sell it to you. They run like mad to buy it from each other. Up it goes. So today they take it down by offering 2 or 3 years production in periods of time when there's very little liquidity. That's where you get these straight line downs from. But you can only do that with paper. You can't do it with the physical. So, because you have to make delivery. The Singapore Exchange, under my chairmanship of the advisory committee, will give cash 3 days and gold immediate. They don't have to, when they offer 3 years production to put it down, they don't have to put up the money. And because they're metals dealers, they don't even have to put up the full margin. So this type of exchange is taking place in Russia. They're starting a cash exchange on the Russian stock exchange. And there are 5 different locations around the world. Of course, I happen to think Singapore will be the leading one, but I'm prejudiced there. Now, the emancipation, that is the event of emancipation of physical gold, the price finding mechanism from paper to physical. Now, physical gold will be much easier to hold price. Physical gold will be much harder to feign supply. Physical gold will be a product of gold taking its proper position as a value. In other words, everything against a value. That's what a standard was. That's what a standard is. So now the countries like China, and if you took a pencil, say you took a green pencil, and you took the entire world, and you filled in all the places in the world which are now valuing their gold at the market price, not at this assumed 42.22 the United States believes, you'll find out that half of the globe now is valuing their gold at market price, including the euro. So gold will be worn like a necklace around the neck of currencies that run their business correctly, who have the surpluses required to buy gold. And the value of currencies will be very strongly influenced, but not by automaticity, but influenced by the amount of gold held. That's why China is buying so much. That's why Russia is buying so much. Now, in 2016, where I see the first attempt of the Great Reset after the Great Leveling, I suggest that the BRICS will make this suggestion, and it will be ignored by the United States. By 2020, the Great Reset will be in place and probably claimed to have been the invention of the West. That's when we start as we were back in the 50s again, going into great long-term industrial agricultural expansions.